Welcome to Countarts. In this lesson, we're going to be looking at the finance lease versus operating lease. We're going to be looking at IFRS 16 and the changes that was made since IFRS 16 came about. So we're going to go through an overview of IFRS 16, and if it's your first time or you're confused with how you handle finance lease, how you handle operating lease from either the perspective of the lessor or the perspective of the lessee, this is the lesson for you. So this is the introduction. If you'd like the other lessons on finance lease and operating lease, you'll find them in the links in the description below. But what is a lease, first of all? Well, a lease is a contract that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So this is the definition of a lease. It's a contract that conveys that someone else can control a specific asset for a period of time in exchange for consideration, and this would usually be lease payments. Now that we see the definition of a lease, what is a finance lease? Well, a finance lease is a lease that transfers substantially all risks and rewards incidental to ownership of the underlying asset. Now we're going to look at some of the things that you have to consider in determining whether this is a finance lease or not. All right, so if this is a finance lease, one that transfers substantially all risks and rewards incidental to ownership of the underlying asset, what is an operating lease? Well, an operating lease is every other lease that is not a finance lease. All right, so all other leases. So the key here is determining whether it's a finance lease, and if it's not a finance lease, then it's automatically an operating lease. Okay, so with IFRS 16, there are obviously exceptions that you can apply in classifying the lease. All right, so you don't have to classify it as a finance or operating lease if it's for less than 12 months, if the lease is for less than 12 months, or it's for a low value. So if it's a low value item, then you don't have to classify it as a lease. So those are the two exceptions with IFRS 16. Now it's important to note where IFRS 16 comes in. Remember, this is what was previously known as IAS 17. So now that it's moved from IAS 17 to IFRS 16, it is the most significant change to lease accounting in over 3 decades. All right, so it brought a very significant change, especially for the lessee. Very important. You must note that the biggest change with IFRS 16, with moving from IAS 17 to IFRS 16, is with regard to how you deal with the lessee, or how a lessee classifies a lease. All right, so it's the most significant change to lease accounting in over 30 years. This change is significant for lessees as opposed to lessors, as I've just mentioned. It meant that after its implementation, lessees no longer classify leases as either finance or operating, but account for all leases in the same way. Very important. Lessees no longer classify leases. So if you look at the question here and you're dealing with the lessee, or you're looking at this question from the perspective of the lessee, your job is not to determine whether this is a finance lease or operating lease. We don't do that anymore with IFRS 16. You will treat all leases in the same manner. Now, what's also important is that if you're using US GAAP or ASC 842, the way you deal with leases from the perspective of the lessee is slightly different to IFRS 16. So if you're looking at this lesson, we are specifically looking at IFRS 16. If you're dealing with US GAAP, you will know that it's slightly different. You still have to determine whether it's a finance lease or an operating lease from the perspective of the lessee. So it's important to note that it's different from IFRS 16, where all leases are classified in the same way from the perspective of the lessee, and we'll see how that works just now. For lessors, however, not much has changed from IAS 17 to IFRS 16, and they still classify leases as either finance or operating lease. So if you're looking at a specific lease and you have to answer questions from the perspective of the lessor, you still have to determine whether this is a finance lease or an operating lease. But for lessees, however, you don't classify leases any longer. Right? So now let's look at the finance lease under IFRS 16. Only lessors classify leases, as we've just mentioned. You have to always remember that. So for a lease to be classified as a finance lease, at least one of the following requirements must be met. So we're looking at this from the perspective of the lessor, because they have to determine, or they still have to see whether this is a finance or an operating lease. So how do they determine that? Well, there are a few things that you have to bear in mind, and at least one, it doesn't have to be all of them, at least one of the following requirements must be met. If only one of them is met, then that already makes it a finance lease. So what is the requirement? Well, by the end of the lease term, the lease transfers ownership of the asset to the lessee. If that's the case, if by the end of the lease term it's probable or the ownership of the asset transfers to the lessee, then you know that it's a finance lease. So if you have that in your scenario where the lease transfers to the lessee at the end of the lease, then you know that's a finance lease. The lessee has the option to purchase the underlying asset at the price that is expected to be sufficiently lower than the fair value at the date that the option can be exercised. Alright, it is also reasonably certain at the inception of the lease that the option will be exercised. Then you know that it's a finance lease. Alright, what's the third one? Well, here we are dealing with the lease term. If the lease term is for the major part of the economic life of the asset, even if the title is not transferred. Okay, so is the lease term a majority of the useful life of the asset? If that's the case, even though the asset will not transfer to the lessee at the end of the lease term, then you know that this is a finance lease. So let me give you an example. If the useful life of a specific asset is 10 years, all right, and then you enter into a lease with the lessee, all right, and the lease term is for 8 years, well, that is for the majority of the economic or the useful life of that particular asset. That lease is a finance lease, all right. But if the useful life of the asset is for 10 years and you're entering into a lease with the lessee and the lease term is only for 5 years or 4 years, then that does not make it a finance lease. You have to look at the other option, whether it's a finance lease or not. But on that point alone, you have to make sure it's for the majority of the useful life. All right, and it's usually we're looking at something between 75%. So if the lease term is for 75% or more of the useful life or the economic life of that particular asset, then you'd know that it's a finance lease. All right, so remember, not all of these have to be met. Like I mentioned, one of these, if one of these is met, then it makes it a finance lease. All right, the next one here is that at the inception of the lease, the present value of the lease payments amounts to at least substantially all of the fair value of the leased asset. Okay, so if you get the present value of the lease payments and it amounts to substantially all of the fair value of the leased asset, then you know that it's a finance lease. And the last one we have here is that the leased asset is of such a specialized nature that only the lessee can use it without major modification. Then this is a finance lease. Okay, so those are the things that you look at to determine whether the lease is a finance lease or an operating lease from the perspective of the lessor. Once you've determined whether it's a finance lease or an operating lease, then that will influence how you treat it in your books as a lessor, as well as how you pass the journal entries. It's different, remember, between operating and finance lease. But if you're dealing with the lessee, you don't even have to determine whether this is a finance lease or an operating lease, because IFRS 16 states that you don't classify leases for lessees. But like I said, if you're also using US GAAP, you still have to determine if it's a finance or an operating lease, even if it's a lessee. Now that we've looked at that, let's see how a lessee accounts for leases, okay? So let's have a look at this. Accounting for leases by lessees, not classified as finance or operating, like we've been mentioning. So at the commencement date of the lease, here is the journal entry that the lessee will pass, all right? So remember, we're not classifying, we don't determine whether it's finance or an operating lease, we're just going to pass this journal entry. We're going to debit what is known as right of use asset around. Remember, this is IFRS 16, no longer IFRS 17, and you credit lease liability, okay? And this is the recognition of the right of use asset, all right? So by debiting right of use asset, you're bringing it into your books and it will go into your statement of financial position, non-current asset, and you credit a lease liability because you have to be making these lease payments, okay? So you will credit that, all right? And the description here is recognition of right of use asset. All right, now after passing this journal entry at the commencement, what do you do thereafter? All right, so here's how you subsequently account for the lease from the perspective of the lessee. You debit interest expense and you credit lease liability, and the description here is interest expense increases the lease liability. Remember, you'll be paying interest on the lease, so you'll have to determine what the interest expense is at each specific period. All right, and if you'd like to check out the lesson where we go through practical examples of how you do this, you'll find the link to that lesson in the description below from the perspective of the lessee. So you debit interest expense, you credit lease liability. Why? Because once you have incurred the interest expense, it increases your lease liability. Once you've done that, then you debit lease liability and you credit bank, and that's when you've just made the payment. All right, and you can see here the description is repayment of lease liability. And then now that you have this asset in your statement of financial position, you now have to depreciate this asset. Remember, we're not classifying the asset, we're bringing the asset as a right of use asset into our books, into our non-current assets, and we have to depreciate this asset just like we do our other non-current assets using the method according to our policies. It's going to be a debit to depreciation and a credit to accumulated depreciation right of use asset. And here it's the recognition of depreciation. So you begin to depreciate the asset just like you would if you bought an asset, all right? But this is specifically for the right of use asset. And how many years are you going to be depreciating this asset for? Well, that's a very important question. Here's how you do it. If the asset transfers to the lessee at the end of the lease, we depreciate the asset using the useful life of that particular asset. Okay, so if it transfers to the lessee, we depreciate the asset using the useful life of the right of use asset. Otherwise, we'll depreciate it using the lease term, unless the useful life is less than the lease term. Okay, so it's very important to note that. So if the useful life of the asset is for 10 years and the lease is only for 8 years and it does not transfer to the lessee at the end of the lease term, then we will use the lease term, okay, of 8 years. Otherwise, if it transfers to the lessee at the end of the lease term, then we will use the useful life of 10 years, okay, because we will continue to have this asset after the lease term has ended. Otherwise, if the useful life is less than the lease term, you will use the useful life to depreciate the asset. I hope that note has made sense. And now you see how you account for leases as a lessee. Remember, here we did not classify, we didn't care whether it's a finance or an operating lease. We just treated all leases in the same way. So whatever lease it is, with the two exceptions that I mentioned, if it's a low value asset, then you don't have to classify it as a lease, or if it's for shorter than 12 months, then you don't have to classify the asset, or you don't have to classify it as a lease. Otherwise, you don't classify it as a finance or an operating lease from the perspective of the lessee. Now let's see how you handle leases from the perspective of the lessor. Remember, only lessors classify leases as either finance or operating. So we have to determine whether this is a finance lease or an operating lease from the perspective of the lessor. So once the lessor has determined that this is a finance lease, what are the measurements? Well, let's look at the initial measurement. And this is specifically for a non-manufacturer or dealer. So this is someone who does not sell this specific asset or does not deal with this specific asset on their ordinary course of business. All right. So this might be their non-current asset that they're using to produce income and they've decided to lease it out. Very important. We're going to look at how the manufacturer or dealer also accounts for leases. All right. But for a non-manufacturer or dealer, what is the initial measurement? Well, the lessor should recognize a lease receivable in the statement of financial position. Remember, once the lessor has leased out the asset, and this is a finance lease, then it has to recognize what is called a lease receivable, because this is how much money it's going to expect to receive from the lessee. The amount of the receivable should be equal to the net investment in the lease. Now, if you'd like to know the calculations of the net investment in the lease, you'll find the link in the description below where we address that, as well as the important aspects when dealing with the net investment in the lease. But basically, the amount that you are recording as a lease receivable is the net investment in the lease. Measure the net investment in the lease by using the interest rate implicit in the lease. And the other thing is that you include initial direct costs incurred by the lessor unless the lessor is a manufacturer or dealer lessor. And we're going to look at the manufacturer or dealer lessor shortly, as I've mentioned. But this one here is not for a manufacturer or dealer, so you have to include any initial direct cost that has been incurred by the lessor. Right? So now, having taken that into account, what is the journal entry for the initial measurement for a lessor who is a non-manufacturer? Well, here it is. You debit lease receivable. As I have just mentioned, you're recording this lease receivable in the statement of financial position of the lessor. So you are debiting the lease receivable, but you are crediting the PPE, all right, the assets that you have leased out. Okay, so you are debiting lease receivable because this is how much you're going to expect. So it's an asset, and you're crediting PPE because the asset is leaving your premises. It's going to the lessee, and it's a finance lease here. So you have to bear that in mind, all right? That's how you account for it initially when you're dealing with the lessor. But here's something interesting. If you're in South Africa and you are doing the journal entries for a lessor, you'll find that we record it slightly differently. So here's how it looks. You debit gross investment in the lease, and you credit unearned finance income, and you also credit the assets PPE. All right? You'll note here that the gross investment in the lease, which is a debit, and the unearned finance income, if you net the two, so the gross investment in the lease minus unearned finance income will give you the net investment in the lease, which is exact same amount for a lease receivable. So if you're in South Africa, I'm sure you will see this in your material. You're not debiting a lease receivable, but you're debiting a gross investment in the lease. And you're crediting an earned finance income, the net of which is the lease receivable, and you're crediting the PPE. So just take note of that. So don't be confused. I'm sure you will see others doing it differently, just debiting lease receivable. And that's how it is with IFRS 16, all right? But just remember that the lease receivable is equal to the net investment in the lease, as I've just mentioned, and the gross investment in the lease minus unearned finance income is the net investment in the lease. So it still comes back to the exact same thing. Now that we've measured the finance lease from the perspective of the lessor initially, how do you subsequently measure it? Well, here it is. A finance income on the lease receivable, and the reduction of the lease receivable should be recognized by the lessor. So remember, when the lessor leases out this asset, obviously it's going to earn interest. So we have to recognize the finance income or the interest income on the lease receivable and the reduction of the lease receivable. So remember, we'll be receiving money from the lessee at specific periods, all right? So whether that's monthly or quarterly or annually, whatever the case may be, you will have to reduce the lease receivable with that. The second thing here is that the lessor allocates finance income over the lease term on a systematic and rational basis. A lessor shall apply the lease payments relating to the period against the gross investment in the lease to reduce both the principal and the unearned finance income. So in one of our other lessons, we go through an example of how we do the calculation for the lease receivable initially and subsequently, what happens when we are receiving the payment and how we account for it, as I've just mentioned in this note. So if you'd like to check that one out, you'll find the link in the description below. But what is the subsequent journal entry? We know how we record the journal entry initially, but subsequently, how do we do it? Well, we debit lease receivable and we credit finance income. Now, what have we done here? Well, we've just added the finance income to our lease receivable. Remember, we're charging interest to our lessee, so that interest increases our lease receivable. So that's why we're debiting lease receivable. We're crediting finance income because it's an income, and income increases on the credit side. And then what is the second journal entry? Well, we know that we'll be receiving money from the lessee, so that's an easy one. We're going to debit bank because money is coming into our bank account, and then we credit the lease receivable with the amount that we have received. So remember, bank is a debit and lease receivable is a credit whenever you are receiving money, because it's reducing how much the lessee owes us. So that's how you do it in the normal sense. Now, if you're in South Africa, like I said, you do it slightly differently. You will debit bank and you will credit gross investment in the lease. And the second journal entry is to debit unearned finance income and credit finance income. All right, so that's how you go about doing that. Again, you will note that the credit to the gross investment in the lease and the debit to the unearned finance income, the net of the two is equal to your lease receivable. So it still comes back to the same thing. So if you're not in South Africa, I'm sure you're familiar with this way: lease receivable debit, finance income credit, bank debit, and lease receivable credit. All right, so those are the two journal entries. Now you can do them as one journal entry, and you will see that, I'm sure. It comes back to the same thing. You debit bank, you credit finance income, and you credit lease receivable. It's still the exact same entry. There's nothing wrong with that. So just bear that in mind. So these are the two ways that you can do it. Now, it's very important to note here that the journal entry is dependent on when the payment is received. So payment might be received at the beginning of the period. It might be received at the end of the period. So that will determine how you do your journal entry. And we've gone through examples, and like I've mentioned, you'll find them in the links in the description below. And that is how you account for a finance lease from the perspective of a lessor who is not a manufacturer or dealer. How do you account for an operating lease from the perspective of the lessor who is not a manufacturer or dealer? Well, here is how it is. Again, we note here that it's the lessor who has to classify the lease as either finance or operating. So the first step, if you're a lessor, is to determine whether this is an operating or a finance lease. Once you've determined that this is an operating lease, this is how you'll account for it if you're a non-manufacturer or a dealer. All right, so the leased asset is still recognized in the lessor's statement of financial position. So with the operating lease, you still recognize the asset in the statement of financial position. All right, lease income from operating leases shall be recognized as an income on a straight line basis over the lease term, unless another systematic basis is more appropriate. So what are we saying here? Well, you will recognize this lease income on a straight line basis over the lease term. So if the lease term is for 6 years and you're receiving payments over the full 6 years, then obviously the total payment you'll be receiving divided by 6 is how much you'll be receiving each year. But sometimes you will note that the lease term is for 6 years, but for the first year or for the first month, you are not going to charge your lessee, maybe because you're offering him this deal. You still have to recognize it on a straight line basis and divide it by the full term, all right, for the full lease term. And you'll see that in the examples that we've gone through. That's what that statement means. But now with IFRS 16, unlike IAS 17, you will note that with the operating lease, both the lessor and the lessee recognizes the same asset in their respective statement of financial position. Remember, with the operating lease, because only the lessor classifies leases, with the operating lease, the lessor is still recognizing the asset in its statement of financial position. But the lessee does not classify the lease as either operating or finance. It treats all leases in the same way, as I'm sure you are aware by now, and it recognizes that asset as right of use asset in its statement of financial position. So you will note that the lessee and the lessor are recognizing the same asset in their statement of financial position. So that's an interesting note there with IFRS 16. Now, what is the measurement for operating leases? Well, here it is. You will debit bank because you are receiving money from the lessee, and you will credit lease rental income, and that is the recognition of the income that you're making. So whenever the lessee is paying you, you debit bank and you credit lease rental income. But that's not all that you're going to recognize. Remember, the lessor is still recognizing this asset in its statement of financial position. So what does it have to do? It still has to depreciate the asset. Even though it's not in possession of the asset, what it will do is that it will debit depreciation and credit accumulated depreciation. That is how a lessor accounts for operating leases in its book if it's not a manufacturer or a dealer, according to IFRS 16. Okay, now that you've seen how a lessor accounts for leases both under finance or operating leases, let's see how a lessor accounts for finance and operating leases if they are a manufacturer or dealer. Okay, so let's look at finance lease. Remember, we are accounting for leases for lessors if they are manufacturers or dealers. So don't make a mistake between what we've been going through for non-manufacturers or dealers with this one here for manufacturers or dealers. Revenue is the fair value of the underlying asset, or if lower, the present value of the lease payments accruing to the lessor, discounted using a market rate of interest. So what are we saying here? We're going to recognize revenue that the lessor is going to receive, but it's measured at fair value of the asset. But if it's lower than the present value of the lease payments due to the lessor, and we're discounting that at the market rate of interest. Now that makes much more sense when we go through examples. So like I mentioned, you'll find the links in the description below. The cost of sales. Now remember, when we recognize revenue, we're also recognizing cost of sales. This is the cost or carrying amount, if different, of the underlying asset less the present value of the unguaranteed residual value. So if the lessor is buying this asset and basically just leasing them out, then the cost of sale will be the cost. Otherwise, the carrying amount, if it's different, and you deduct the present value of the unguaranteed residual value. A manufacturer or dealer lessor, which is what you are dealing with here, shall recognize selling profit or loss on a finance lease at the commencement date, regardless of whether the lessor transfers the underlying asset as described in IFRS 15. So remember here now, you also have to take into account IFRS 15. So what is happening here? Well, you will recognize selling profit or selling loss on a finance lease at the commencement date. So it is at the commencement date, even though you may not have transferred the underlying asset to the lessee. Right? Initial direct cost incurred by the lessor is not included but expensed through profit or loss. So unlike a non-manufacturer or dealer who includes the initial direct cost, for a manufacturer or dealer, they do not include the initial direct cost, but it's expensed through profit or loss. Selling profit, as you would know, is also recognized through profit or loss. So what is the journal entry that you would pass if you're dealing with a finance lease from the perspective of the lessor, who is a manufacturer or dealer? Well, you will debit lease receivable because there is an asset, because money that is due to the lessor by the lessee, and you will debit cost of goods sold as well. You credit revenue and you credit inventory. And what do you notice here? Well, if you know how you pass journal entries, very basic journal entries using the perpetual inventory system, you know that you're not only taking account of the sale, but you're also taking account of the cost of sale and inventory. So you will usually debit receivable if you're selling it on credit, but in this case, remember, it's a lease, so it's a lease receivable. You will credit revenue, and then the second journal entry would be debit cost of sales and credit inventory. But as you can see here, you're doing it as one journal entry. And if you have initial direct cost that is incurred by the lessor, well, you will debit initial direct cost and you will credit bank. And like we mentioned, you will do this if it's a manufacturer or a dealer, because we're just going to expense it. Okay, and that is how you account for finance leases if you are a manufacturer or dealer. What about operating leases for a manufacturer or dealer? How do you account for it? Well, let's see what happens here. The lessor does not recognize selling profit on the operating lease as it is not equivalent to a sale. Remember, this is not equivalent to a sale here because you are leasing it out and you will get it back. It's an operating lease. Remember, lessor still classifying leases, so this is an operating lease. For a manufacturer or dealer, there is no selling profit because this is technically not a sale. And that is how you account for operating leases and finance leases from the perspective of the lessor if you are a non-manufacturer or if you are a manufacturer, as well as how a lessee accounts for leases. I hope this lesson has made sense. I hope you're able to get a gist of IFRS 16 and you're able to see how it's different from IAS 17. You can see that for the lessee it's changed tremendously, but for the lessor not much has changed. I hope you've gained value from this lesson, and if you have, consider subscribing to our channel, like this video, and share it to those you think it might help. Till next time, cheers.